Let's rock and roll. Let me go ahead and put up a little question for you all. Why is everybody here tonight? Everybody comes in for different reasons, depending on where you're at in your life, what you're trying to do. Maybe you're super satisfied in a 9-to-5 job and you're trying to do other things. Maybe you're an entrepreneur, business owner, and you're trying to do other things. Maybe you're an investor. But I'm super curious. Chime in on that poll I just put up there. Are you tired, mad about current situation? You need some help? You want to level up, as they call it? You know that multifamily is a great way to go. You just don't know where to get started, right? Or, hey, I'm just curious about multifamily. Not sure really what I'm doing. And, hey, I make decent money in a job. I have a W-2. I'm a good income earner, but I'm looking for something more. I'm looking for something greater, okay? So super curious about why you're here tonight. Everybody has different reasons. Grow your family. I love it. Firm. Beautiful. Thank you for sharing that. We can help you do that. The community can, and that's kind of the whole design. What you soon learn, and if you're not in it at all, you don't understand the importance of this, but how important collaboration, partnerships, and community are in multifamily investing, okay? There are very few people going out there stroking checks for 10, 5, 10, 15, $20 million apartment complexes. Typically, when those things go down, no different than we do today in the bigger space, we are collaborating and partnering because that's how you grow. That's how you scale your money. That's how you get to thousands of units, right, in your portfolio. You're typically not doing it simply you signing and taking everything down yourself. Very, very, very rare, okay? So that's why community partnerships and collaboration are so critically important. So awesome. Let me go ahead and end that, and I'm going to share the results so that way everybody can kind of see. Pretty even across the board. Definitely the first one was the winner. But just below that, you're just curious about multifamily. Not sure what you want yet. I love that. Fair enough. So let me go ahead and stop that. And let's kind of jump into it. I was thinking about starting this a little bit differently this evening on the next slide I'll show you, but I have people ask me all the time, Justin, why multifamily? Right? There are so many different asset classes and areas of real estate investing. Why multifamily? I hear so many different opinions on different types, whether it's flipping, wholesaling, Airbnbs, right? Do I do mobile home parks? Do I do flex space? Do I do this? Do I do that? Right? You can get very confused very easily. I keep it very simple. Right? I always say be an inch wide and a mile deep, right? Versus a mile wide and an inch deep. You want to be specialist in something. You don't want to be the jack of all and the jack of none. So inch wide, mile deep. So I say this, people need three things. They need food, they need water, and they need shelter, right? Food, water, and shelter. And you in the apartment space, right? Single family apartments, whatever it is, but specifically in the apartment multifamily game, you're providing housing and everybody needs it at any point in time. You either rent or you own. And more people are tending to rent these days than own. And you're seeing that demographic switch, and we're moving more towards a renter nation, similar to what Europe has now. And we're following right in their footsteps, typically 10 years behind, but we're moving there. Okay, 1 in 4 properties in the United States of America. It's a huge number, everybody. 1 in 4 properties in the United States of America are owned by institutional Wall Street, big conglomerate firms. Blackstone, right? The name keeps going on and on and on. You name it. The big institutional conglomerates own 1 in 4 properties in the United States, and they rent them. That could be single family or multifamily. Okay, so it's huge. It's huge. So, but why multifamily? I think this is the key one. You get paid throughout the transaction 5 to 8 different times at different periods throughout the ownership of an apartment building. 5 to 8 different times in different ways. And I'm going to show you that, okay? The economies of scale. I was just talking with a buddy about this. Why would you have 10 single family homes, like rentals all over like a neighborhood or a couple neighborhoods when you can have one building with 10 units in it? And I asked him this and he said, well, Justin, I understand that the economies of scale makes sense. It logistically makes sense, financially makes sense. I just don't know how to find those, analyze them, finance and do the structure and the capital, and how do you put that thing together? How do you close escrow on it? How do you manage that thing? It just seems more daunting, so I don't approach it. Single family makes easier sense. right? That's typically what I hear, right? Is that probably in line with a lot of folks. But the economies of scale of a 10-unit building in one location where you have, maybe even one water heater system, one roof, right? One insurance policy, right? You have 10 units, so therefore one moves out, you're still 90% occupied. You have somebody move out of your single family rental, you go from 100 to 0 really fast, okay, really fast. So economies of scale from repairs, maintenance, income, everything, okay? It's easier to finance. See, what people don't understand is that when you go buy a home, single family home, and you go get financing on that, the bank is looking at you personally, your tax returns, your income, your W-2, your everything to substantiate whether or not they give you the loan, right? It's a whole, it's like going through a complete dissection of you. If anybody's done that, you understand that. You go into the multifamily space, it's easier to finance it because the lenders look at the property as its own operating business. It has an income, it has expenses, and a profit. And that profit pays them. Right? It's a net operating income number. And that net operating income number pays the bank their mortgage payment every month, not you. Right? The property takes care of itself, right? Self-reliant. That's why they look at it, it's easier to finance. So as long as you're not a fraud and you have reasonable credit, right? At least 600 or more, right? It's not too difficult to get this type of stuff financed. Much easier than getting a $200,000 home loan. You can get a $1 million multifamily. Much easier, okay? Any questions so far? I'm going to keep going pretty quick so we can stay on time. Generational wealth. This is kind of what everybody talks about. You hear these terms thrown out, but generational wealth, to give this off to family members, to kids, to people. You want to level up and do some things and have this like asset there that you can transfer on or do things with later down the road. So the generational wealth aspect. So those are really the the reason that why my multifamily is so important. I'm going to get into the ways you get paid here in just a second. But that's why multifamily. Okay, 5 to 8 ways, economies of scale, easier to finance, and generational wealth. Okay. So these timelines. Does anybody remember this year? Good old 2008. We'll get into that question in just a minute. Great question. How much do you need to get started? We'll go into all that here. I'm going to break it all down for you. So a little bit of background on me, if you're not familiar with who I am. Justin Brennan, multifamily investor. I kind of grew up in real estate a little bit. My dad, my grandmother, and then my dad, and he was kind of a transitional character in our family where we didn't grow up rich by any means. We had a little 3-bedroom, 2-bath home in Dory Road in Bonita, California. Started with that, and then my dad kind of made it big, right? He took our family and got into building single-family home developments and then big developments and all these other things. And he had this meteoric rise, which was incredible. And I watched it all go down. But he was always in the build and sell game. So any kind of changes in the economy from the savings and loan crisis of the late 80s, early 90s, all the way into the financial crisis of 2008. I watched him go through a massive bankruptcy, lost everything. It was devastating. And to see that happen to, of course, your dad and then family, it did a 180 on me, but obviously destroyed him because he had to then rebuild, but never really fully rebuilt. But he had to go through that. So I went through that, the financial crisis. Has anybody else been through that? Does anybody remember it? Were you hammered? Was your family hammered? Did you have divorces, foreclosures, issues, problems? Anything else happen? Chime in the chat. Chime in the chat, okay? Because this was an incredible opportunity and learning experience. And even in the midst of all of that, and I was getting clobbered, right? I didn't have a lot of money at that time. I'm getting hammered. I knew we had to buy property. And I went to a buddy of mine because I didn't have any cash at the time. I went to a buddy of mine who was in the tech industry. And I told him, I said, listen, man, I'm getting hammered. I don't have the capital, but I have the ability. I have the skill set to go find deals, analyze them, put them together, close the escrow, manage them, and all that stuff. So I can go find these deals, man. Can you help bring in the initial capital and sign on the initial loan? And we'll just split everything 50-50 and then let me do all the grunt work, the sweat equity, as they call it. And so our company was founded in 2010. And we went out and we bought our first deal. It was a $100,000 condo. I kid you not, a $100,000 condo in Murrieta, California, in the midst of the financial crisis. And then from that condo, then we started getting into little duplexes, triplexes, some 4-unit deals, like all the still residential, still 1 to 4 unit stuff. But we were doing most of this with our own money, thinking we'd made it big, right? Great, look at our portfolio. We have 20 units, right? Which is fine. It's great. But then we understood this thing called OPM. It's like a light bulb went off. OPM, other people's money, right? Where you take your money, some of your money, in conjunction with investors who want to invest in real estate, no different than all of you here tonight. And you leverage that correctly to scale and grow. And so from kind of this period, right, because kind of in this window, we grew to about 20 units, okay? And then from there, right around 2017, 2018, we got, and I learned this game of syndication, right? What syndication is, it's some fancy word. All it means is that you and investors, you're collaborating together with money to go buy real estate. So technically, any time that you are raising money from anyone to go buy real estate, technically, it is a legal syndication. However, that term and the legalities and all that stuff don't really get thrown into the mix until you're starting to raise money from people you may not know that well. That's typically where the term gets thrown in a lot more, okay? But syndication. So we went from this point right here in 2017, 20 units, right? From here to here, we went to about 450 units, okay? And from here to here, we've added, because of the crazy markets, interest rates, and all that stuff we can get into, right around that, plus or minus, today. And about 180 plus million in assets currently under ownership. Now, we don't have 100% ownership of 180 million, but we have about 40%, okay? Because we went in, right, with some of our own money, brought in investors and everybody else into those deals, right? So they have 70 to 60%, right? I'll show you the math of those deals, and then we have 40%. But it allowed us to scale our money because we were able to take money out of these deals, position it into this, and go from 20 units to 600, just like that, by doing it correctly. And now we have a piece of a much bigger pie. Makes sense? And so that's kind of my background in history. And then our goal is to get to 10,000 units and 1 billion plus in assets. That's where we're headed, right? And where we want to go. And we would love to partner and collaborate and do things. And that's the reason why a lot of the stuff that we've done has come to fruition. That's even why you're here tonight, is because of community. And we're going to show you some things. Has anybody talked to you? Anybody here learned this? The game of money. You lost over $40 million. Is that what that means? You lost over 40. Oh my goodness. I may have to bring you up tonight to chat. That's a good one. Well, without giving the numbers, my dad was 60. So it's pretty wild. Yeah, that's a wild time. I vividly remember it. It was actually April 8th, 2008. I mean, a lot of eights here. April 8th, 2008 at 8:35 in the morning. And my dad walks in my office at the time, because I was actually working with this company at that time, sits down, closes the door, and says that the banks have shut all the loans down, because we were under construction on a lot of deals at that point. But the banks came and just shut everything down unilaterally, right? And I'm like, well, they can't do that. And he's like, yeah, I told them that. But they didn't care. They said, sue us. Because they knew what was going down. They knew everybody was going down. It was a big old poof in the air, in the sky. But I remember that vividly, because that was the beginning of the poof implosion. So rock and roll. Hard to build, easy to lose. That's a heck of a term right there. Okay, great on the, if you have not voted yet on your real estate experience. So a lot of novices here tonight. I like that. Some people own, right, and have owned some rental properties before. I like that. So kind of between the two, let me share that real quick so everybody can kind of see. Generally speaking, you got novices and own some. So everybody's had some experience or brand new to it. Beautiful. So I'm going to give you a short version of the presentation that was given to me a couple years ago that like blew my mind, because I was like, whoa, now I get it. The whole U.S. capitalistic system and how it's designed. It's a big game, everybody. It's a big game. It's a big game between creators and contributors. Creators and contributors. Creators are business owners, entrepreneurs. They create products and services that go into the marketplace that then get consumed by the contributors over here who take out their pockets and give away money to use the products and services to go right back into the pocketbooks of the creators over here. And that is the entire United States capitalistic system. Creators create jobs, opportunities, products, services, everything, right? Goes into the market. Market absorbs it through the contributors. Contributors pay it back to the creators, and it leaves the pocketbook over here, and it goes to the pocketbook over there. And that is the entire U.S. economy. Okay? You're 1099 over here typically. You're a W-2 employee, and you could be earning great income as a W-2 employee, right? But you're working 9 to 5. You're working for the man, as they call it. Working for the man, as they call it. But creators. And then we have our friends called the IRS. Does everybody enjoy the IRS? Just say how much you love them. Oh, man. I love everybody. I should ask this question. They're like, hell no. They hate us. They hate us. Okay. Here's how the IRS works, guys. The IRS loves the creators. Okay? They love the creators. I'll get into why. The IRS does not love the contributors. Why? Why? The reason that the IRS loves creators is because they move a lot of money. When you move a lot of money, that's what the entire capitalistic system is designed up as, guys. When you move a lot of money, you create opportunity, you create jobs, you create products and services. You create and you move a lot of money in the U.S. economy, a lot of wealth and opportunity is created, right? So the IRS, because of that, is going to give creators an enormous amount of tax breaks because they're taking an enormous amount of risk. And by taking all of that risk to grow things, right, and create opportunities and services and products and all these things, all this risk that they're taking to create all of this and move a lot of money, they're giving them a ton of tax breaks so they can grow that wealth to a huge amount. And it's not because the IRS is doing this out of their good old-fashioned heart, right? They're not stupid. They're just trying to allow these folks to grow so they can take a piece of a bigger pie later, right? They want them wealthy so they can go get it later of a bigger pie. Over here, if you're a W-2 employee, you know this. You get very limited tax deductions, do you not? And you're probably saying, why? Like, why don't I get the same deductions as these folks over here? Why are the rich getting richer? And this, why are nobody paying taxes over here and all this stuff, right? The corporations and the businesses and all this, why are they not paying anything? Because they're moving a lot of money and they're creating a lot of things. And the IRS loves them for that because they want a bigger piece later. Over here, because you're not moving a lot of money, they can't take as much away. You get your basics and that's it, right? You're a piece of the machine, right? That's how it works. So if you want the financial freedom, like everybody was talking about, you want generational wealth, you want time with family, you want to do all these things, it only happens here. It really can't happen here. It's not to say you can't do well. It's not to say you can't do well. It's just, it's harder to happen here. You're going to be working till you're 65 or 70 or more, right? Because that's the way the system's designed. Everything you want is right here. It's just a question of how you get it. And that's why you're here tonight. How do you learn about multifamily? How do you do this? If you're sitting here or if you're sitting here, how do you get to the next stage and get into the multifamily game? But that is the game of money. That's capitalism in the United States of America. So if you're here and you're mad at these people, don't be, because that's how the system is designed. Just get even, as they call it, right? Get even and become part of it. Become part of it. Does that make sense? Thumbs up if that makes sense. Cool. So let's get into your motivations, because this is really important, right? Let's get into your motivations in life, because money is a great motivator. Don't get me wrong. I love money. I'm motivated by money. But when you start to make some good money, right, the drive right inside of you is not about the money anymore. It then becomes about bigger things. So I went to a conference not too long ago, and I was sitting there with Patrick Bet-David. Anybody knows who Patrick Bet-David is? Okay, and I'm sitting there, and he's up on stage, and he's talking about all these things. He says, okay, everybody, here are the 7 mountains that move a nation and inspire people. This evening, your homework is to go and identify the 3 or 4 of these 7 that resonate with you in your belly, that get you fired up, These are the things that'll get you out of bed when you don't want to get out of bed in the morning. That'll keep you going when you're like, oh, I don't want to do it. Because money will only get you so far. So I ask you this, I'm going to put up the poll. What are your mountains? What are your mountains? Sports and culture? Is that exciting to you? Does that drive you? Is it family? Not just family, but also philanthropy, giving back. Media, government, business, education, religion. Which 3 or 4 are most important to you and drive you in your belly? So let me show you how it works, because these are mine. This is how it works. So business, number 1, you have to have a successful business that you can take and feed some of your other passions, right? They talk about what is money, right? It's a tool. It gives you choices, right? Successful business gives you money, which gives you choices. Now you come into number 2, which is the education. That's why we created the community multifamily school, which is why you're even here tonight, right? You're sitting there seeing all the stuff, you're coming into this stuff. We created a community of collaborative investors and the education side teaching you this stuff. Number 3 is the media, utilizing media and podcasts and other things to get out the messaging to help educate, okay? And then lastly, most important than anything is your family, right? And yes, your personal family. Maybe you got kids, your loved ones, whoever it is, awesome. But then it also goes a step beyond that to your legacy, right? And your last name. Where's it going to go? Are you going to give back? Are you going to help others? Are you going to leave a legacy? For me, there's really 3 causes or charities, right? It's the Tunnels to Towers organization that gives back to pay off the mortgages of spouses left behind with their kids from people in the line of duty. Tunnels to Towers. Number 2, SEAL Future Foundation helps transition Navy SEALs, team guys, into civilian life and gives them support. Number 3 is disadvantaged kids, right? Because I've always believed, you see kids in really bad environments and you just realize that, look, if they just had education, like the belief that there's something more, and a role model, in a way, mentor, role model, whatever you want to call it, those 2 things are so powerful to take a child who just maybe had a bad starting point and allowing them to go 0 to hero. Like, I love that stuff. And those stories are endless and they're out there. Okay. But they typically had a role model and they typically at least had some belief or knowledge that there was something greater than their bad situation. But those are my causes. So I love these that everybody shared. It's great. It's great. I'm going to share your results so everybody can see them. A lot of people had it in here. Education, business, family. Some people had sports and culture. Religion was pretty heavy in this. That's great. Faith. Whether you're a religious person or just a spiritual person, but having faith, right? Having faith and being grateful. So I always say this, I don't know if you do this or not, but if you want to get your mind in a good spot every morning before, you kind of get your day going, before you get out of bed and you roll up out of your bed, before you put your feet on the ground, do yourself this tonight for tomorrow. Say 3 things that you're grateful for. Just 3. Could be the same things every day. 3 things you're grateful for before you put your feet on the ground and you get going in the day. That alone, it's really impossible to be sad when you're grateful. Really difficult, okay? So awesome. Let's keep going. But this is important for you to remember, because this is going to drive your decision-making and getting you, when you kind of get to the edge of the cliff sometimes and you're not worried, should I do this, right? Should I go to multifamily? Should I do this, right? It's going to get you going. That's what's going to get you out of bed. These are really important. So that's what I kind of lead into with the community. So a couple of years ago, we created Multifamily School. It's a community of investors well-trained around the country who are collaborating, partnering, doing deals, coming together. That's critically important because that's how you grow, right? And sharing information, training, all that stuff that happens collaboratively around the country through a really powerful community. And that's what we created, because that's how I'm getting to 10,000 units. I don't know where you're going or where you're wanting to go, but I'm curious. Is it 10 units? Is that ultimately all you want? Is it 20 units? Is it 100 units? Is it 50? So multifamily schooled community, right? That is why this was designed to collaborate with great investors like yourselves to come in and realizing that multifamily is about partnerships. That's how you grow and get to the numbers you're talking about. You do not do it alone, okay? You do not do it alone. Collaboration, partnerships, community are everything. Everything, okay? It's everything. All right, let's jump into the meat. That's why everybody's here. Not just to get motivated like Tony Robbins. You're here to get some details. So, and by the way, this is all recorded too. So, and typically within about 4 or 5 days after this live event, we'll have it up online if you ever decide to go back, FYI. How to buy apartments. Okay, how to buy apartments. And I call it the 5-pillar method. The 5-pillar method that we take everybody through and teach them A to Z on how to buy apartments. You know, first and foremost, you got to know how to find them, right? How do you find the good deals, right? Typically pre-market deals. How do you analyze them quickly? What metrics do you look for? How do you finance them, structure them, put them together? How do you close escrow? How do you manage? Okay, so let me ask you this question. What are your roadblocks? Out of these, which ones would you say are your biggest roadblocks? Curious. So you'll see a pretty consistent theme. And I almost know the results every time because I've spoken with enough people and we've helped enough people in the community finding deals. I mean, if you can't find good deals, the rest never happens, right? You got to start there. Okay, analyzing, but then financing and capital, that's typically where everybody gets roadblocked. Which is one of the main reasons, like in the mentorship community, that came up with a lot of the mentees. And they said, hey, Justin, like, you're teaching how to go get the lenders and capital and all the stuff, but do you have access to a lot of that? And do you have access to lenders that you could bring into the back end of the community? And then when we have deals, we could just submit them right to them and not have to go find all the lenders and do all the financing side of it and just submit our deals and they can look at them, underwrite them, and provide the financing for the deal. So I was like, that's a great idea. So we brought all the lenders into the back end to help fast track on the financing and capital side. So people aren't having to go track all this stuff down. How do I get my loans, right? How do I get my capital? We bring all that into the back end of the community. So that way we remove some of those roadblocks and allow people to streamline their process of buying. Okay. Awesome. I'll share those so everybody can kind of see them. You can see finding, financing, typically the big ones, analyzing. It's funny because a lot of people have closing escrow and the deal structure down towards the bottom, but you will soon learn, right? It's actually the most important one once you get through the other ones, right? The closing the escrow, hands down, is the biggest portion that you don't know until you know it. And then when you go through it, you're like, oh God, okay, makes sense. Okay, here we go. So doing that. So I talked about the different ways you make money because people ask me, how do you make money in multifamily? If I'm putting these deals together and I'm kind of the main general partner, they call you general partner or sponsor or syndicator, or you hear those terms thrown around a lot. How do you make money doing this, right? And how does it all structure? So you get paid 5 to 8 different ways, right? Remember I said 5 to 8 different ways? Here's how you get paid in multifamily. So you're going out there, you're finding good deals, you're putting them together for you and for investors. For doing that, you get acquisition fees, and those are paid one time, typically at the beginning of the transaction, and they range 2 to 3% of the purchase price. Second, asset management. This is different than property management. So every month, based on the revenue of the property, for managing the managers, you get paid an asset management fee. Typically, that's 1 to 2% of the revenue of the property. Then, for bringing in a small portion of the capital, typically 5 to 10% of the money requirement, you will get 30 to 40% of the deal. That gives you 30 to 40% of the cash flow monthly, 30 to 40% of the profits, typically during a refinance or a sale, 30 to 40% of the tax write-offs, which is one of the biggest parts of buying real estate. Then if you're going to be doing renovations on the property, let's say you're doing improvements and renovations, you can also get paid a construction management fee monthly, 5 to 8% of the construction costs. Then you can get, if you sell the property down the road 5+ years from now, you get what's called a disposition fee, dispo fee. One time, typically a 0.5 point to 2% of the sales price when you go out the door down the road. And then lastly, finder's fees. So if you're good at finding deals and you can bring those deals to groups, you can not only get brought into the deal itself, but you can also get paid typically a finder's fee. And it ranges, right? 1%, 0.5%, 2% of the purchase price. Really depends. But a finder's fee, if you're really good at finding deals. So how do the time, because people asked the other day, they say, okay, great, those are the 5-day ways, but how does it like timeline out? If I'm going to own something 5 years, how would I get paid? Okay, how would I get paid? So when you buy the property, purchase point, you get the acquisition fee or the finder's fee. Acquisition fee or the finder's fee, or both. But that happens right at the beginning of the ownership. Then what happens throughout each year and month, right? You're getting cash flow, getting all that stuff coming in here. You're also getting the asset management fees if you're getting that. You're also getting construction management fees if you're doing renovations in the first couple of years, on and on and on. So there's a lot of monthlies that come into it as well. Then usually around year 3, you'll do a refinance on the property after values have increased. You can pull some cash out, pay back some investors. So now you own more of the property and you have more of the control as well. Then you go a few more years and you could either sell it and get a profit, or you can refinance it again and just keep holding it longer. And then every 3 to 5 years, you can refinance out investors up until the point, maybe at some point you own 100% of that building and you have no more investors involved in it. You can do that. It's an option. We've done it. Okay, we've done it. So that's typically how you get paid in multifamily. The 5 to 8 different ways and a basic timeline of when a lot of that stuff would happen. So finding deals. I try and keep this really simple for folks. Okay, there's only 2 ways on this planet to find multifamily deals. Real estate in general, but multifamily specifically. Okay? You're going to have direct to the brokers or direct to the seller. Direct to the broker or direct to the seller. Now, both methods work. Both methods work. But if you are in work and you have a job or career or a business or whatever it is you're doing every day, you probably have limited time. So you don't really have an enormous amount of capital and time to be spending bird dogging and going direct to sellers to try and get them to raise their hand and say, yeah, I want to sell my multifamily. Could it happen? Sure. But is it a good use of your time? No. The reason why is because for every single phone call you may make, text message you may send, letter you may send out to the property owner, the brokers are doing 5X. They will 5X anything you can do. They have people on the phones every day dialing for dollars, baby. And they're locking up deals. So the best way to actually be the most efficient with your time and get the most out of your time while you're doing your current job and your profession and everything you're doing right now is to go to direct to the brokers. Direct to the brokers. I'm going to show you how this works. So on the direct to broker approach, since we've kind of agreed that's the route we're going to go, and that's the route we teach and everything that we do, and that's how we got started. When we did our first kind of larger apartment complex, it was a 27 unit in Kansas City, Missouri. And in that deal, we leveraged on-market brokers to get access to their on-market inventory, right? Because they're saying, hey, we're a broker in the market. We have active listings. And I could get access, get to know them. And now I get access to their pre-market deals. So you leverage the websites, whether that's LoopNet, CoStar, maybe you've heard of Crexy.com. All of these websites get you access for free to look at commercial properties, multifamily, anywhere in the United States. But just know that out of all the properties on these websites, it only makes up at most, and I say at most, 40% of the actual deals available for sale. Because at least 60% of the deals available for sale go in the pre-market phase. Because this is how it goes down. Brokers making calls, okay? Brokers making calls all over the place. They're getting deals, blah, blah, blah. They lock up a listing. They get a seller to lock it up. They call me all the time. Hey, Justin, you want to sell this? Hey, Justin, you want an offer on this? Hey, Justin, you want an offer on that? And I say, no, we're good, we're good, we're good. Let's say I said yes. So now they're going to get the listing. They have the listing. It's a pre-market kind of pocket listing. They're going to get everything ready market-wise. They're going to then distribute it quietly behind the scenes to their database of investors who have connected with them and built a rapport. And then if it doesn't sell in that pre-market phase, then it goes to the websites. But I ask you this question. If it didn't sell here and all of those investors passed on it and it goes to the websites, do you think it's overpriced or underpriced? Do you think it's a good deal or a bad deal maybe? Probably not that great of a deal. probably overpriced, probably doesn't make financial sense. So I'd be willing to bet you that 95% of the deals on these websites, overpriced, don't make sense. When you analyze them, the numbers won't work. That's not the point though. You can leverage these to get to these. Leverage these to get to these. And that's how we got started. That's how we teach everybody what to say, how to say it. All that stuff goes down when you're doing it. Let me give you an example. You're going to leverage the brokers on market deals to get access to their off market stuff. And you're going to focus in the 10 to 30 unit space. 10 to 30 unit space. Let me share something with you on the phone or on the computer real quick. Because I'm going to give you the example deal here in just a minute. And hang in there. We're going to go a little long tonight, but not too long. It'll be worth your time. So let's take a look right at this deal right here. Okay, that is this one on Baker's. So I kind of looked at it before we came on. This one is we're in Kentucky. Little 8-unit deal, right? Let's presume it was 10 units for a minute. And I'm kind of scrolling down. I'm looking, okay, look at this. Here's the broker, Kurt and Zach. Those are the brokers representing the deal. Let's say I had interest in Kentucky and I wanted to go into areas of Kentucky and I picked out a market. So I'm going to come right here onto the website and I'm going to look for deals like this, similar. I'm going to pull them up, right? Here's a little 32 unit. Some other ones in here I'd have to designate. I think I need to go in here and just do multifamily only. But this little 24 unit, and I just pull up the deals. Then I'm going to call Kurt. And I'm going to say, hey, Kurt, how are you? It's Justin Brennan with the Brennan Pulley Group. I'm actually over here looking at this deal on Baker Springs. Looks like new construction. Did you guys just put that on the market? Looks like a couple days ago, right? Okay. Tell me a little bit about it. Like, who's the owner? Why are they selling? Anything about it we need to know? Is it brand new construction or a few years old? Looks like it was built in 2024, so brand new. Okay. Why is the owner selling? Oh, okay. So they got a construction loan and it's coming due and it's variable rate and they can't get out of it. So they're looking to kind of sell it, get out from underneath the payments and everything and give it off to somebody else. Okay, awesome. We'll say, hey, Kurt, I'm going to be in town in a couple weeks. I'd love to connect with you right before I come out, see if the property's still available. And then I'm going to tour, if it's available, I'd like to tour that property. And I'm looking at a few others in the area too, but I'd love to tour it and take a look and see if it's of interest and maybe do a deal together. Okay. And they may ask you a few questions like, who are you? Have you done any deals before? Blah, blah, blah. Don't worry about that. Okay. Don't worry about that. We fall in line. We teach people what to say, how to say it. It's not that difficult in general. Keep in mind, the reason why this works, you're staying in the space. If somebody came to you and if you've gone on other webinars and other gurus out there teaching stuff, no, go 50 plus units for your first one. Listen, I understand why they're teaching you that. It's just never going to happen. Never going to happen. You have a better chance of breaking into the White House than you do of getting a 50 plus unit deal if you've never done one before. Lenders not going to give you the time of day. Brokers aren't going to give you the time of day. Sellers aren't going to give you the time of day if you have zero resume. However, when you're newer and younger and you're trying to get into the space, staying in here for your first couple deals will build the resume, will build the rapport, will build the execution, will build the knowledge, will build everything. And then you can go for it. Because if you stay in this space, then you'll get brokers to call you back. If you stay in that space, lenders will deal with you. If you stay in that space, it's bite-sizable from a capital side as well. The loan and the down payment equity. Bite-sizable. You can take it down. You can actually execute the plan. If you try and go too big, best of luck to you. Unless you have big pockets, you can go make it happen. Rah-rah, but not likely. It's not likely. So, awesome. Yeah, I love that. Exactly. So that's that space. So that's how you're finding deals. Leverage the brokers on market to get access to their pre-market deals. No different than we do today. It's how we execute. It's how we get deals. Pre-market. Pre-market. So what makes up a good deal? And I'll run through this quickly and then we're going to keep it open for Q&A. So 14 to 20% annual rate of return on the deal. So we have deal analyzers. You're going to get one here in that multifamily toolkit, okay? But we give deal analyzers as part of our package and stuff. You get like a simple one, which we keep everybody at 0 to 50 units, like a nice simple one. And then we have a much more complex one that's like thousands of dollars worth of stuff, right? But you'll get into that once you get and you do bigger deals. 14 to 20% a year. And these deal analyzers pump out these metrics for you. So you're just plugging and playing numbers real easily, and then it's giving you the answers. So 14 to 20% a year on your money. On your money, that's what you get. Cash on cash of 6 to 10%, meaning if I give you 100 grand, I physically get 10,000 in cash, 10% cash on that every year. This includes appreciation as well. The annual return includes appreciation of the property. And then this is called an equity multiple. Okay, equity multiple, 1.8 or more. I'm not going to get into too grave detail on that, but just want to show you if you're looking for metrics and you're looking at your deal analyzers trying to figure out, is this a good deal or not deal? If these three match, you can dive in deeper. If they don't match, you move forward without it. Okay. So that's what makes up a good deal. Let's look at how you analyze. Because when you analyze deals, right, you saw the metrics. When you analyze deals, you're always trying to maximize net operating income because that's how buildings are evaluated, right? When you're looking at the value of a commercial property, the value or the price is equal to the net operating income divided by what's called a capitalization rate in the market. These are determined by sales. These are determined by brokers and lenders. It kind of cap rates, generally speaking, for the marketplace. So we can get into how that gets calculated. But value equals NOI over the cap rate. It's not about how I feel. It's not even about what the property next to me sold for. Because the property next to me could have sold for a lot more, a lot less, depending on this formula. If they maximize net operating income and we're operating as a very successful business, their value is going to be much higher than mine, even if it's an identical property. Okay? So analyzing deals, the power of net operating income. If I can just raise the net operating income $1,000 a month on that property, that's $12,000 a year. And I divide that 12,000, right? Because I'm boosting it up 12,000 a year. That's net operating income divided by 5.5% cap rate. Okay. That divided by that gets me $220,000 in value right in my pocket. Literally, by boosting it $1,000 a month, I put $220,000 in my pocket. 1,000 a month, $220,000 in my pocket. For every 1,000 I go, 220, 220, 220. Make sense? Extremely valuable. The power of NOI. Power of NOI. So then how do you evaluate an apartment building? I mean, in a way, no different than any rental property. It's just now you have more zeros in it, and there's a little more detail in it. But same formula. Okay? So whether it's a 2-unit or 100-unit plus, doesn't matter. It's going to follow this exact same formula. The gross income on the property minus economic loss. Economic loss includes 4 things: vacancy, loss to lease, bad debt, concessions. Vacancy is exactly what it sounds like. Physical vacancy in the property. How many vacant units? Loss to lease means if market rents are $100 and I'm getting $90 on my rent, I have a $10 loss to lease. Bad debt. People don't pay rent. Concessions. And sometimes you got to give tenants 3 months rent to get in. You calculate all that up. That's economic loss. Then you're going to add another income. This could be pet income. This could be reimbursables on utilities. It could be parking income, right? All that stuff goes into other income. This gets you a thing called EGI, effective gross income. Effective gross income. Then you take out your expenses, which typically are going to run 30 to 50% of that number. And that gets you your net operating income, NOI, which comes over to the formula. Then you take out your debt service, your mortgage on the property, and then you get to this beautiful number that everybody likes to call mailbox money, and that's the cash flow in your pocket. Cash flow in your pocket. Raising money. This is where everybody gets stuck, right? They get to the bottleneck. Remember I was telling you earlier how we kind of brought in the financing, brought in the capabilities, everything in the back end of the community and system to help kind of relieve this bottleneck that everybody gets caught with? Well, this is how we do it. So when you're raising money, you're dealing with debt. That's the loan on the property. And the equity, that's the down payment. In terms of how that equity gets raised, because people, I hear it all the time, right? They get stuck. They think, I don't have anybody that has any money, friends or family. I don't know anybody that has any money. I don't even know where to start. How do I do this? How do I do that? So you're creating these self-limiting beliefs. Because what you're not realizing, okay, what you're not realizing is that in order to raise money, you really just need three things. You need a deal that makes financial sense. So it always goes deal, debt, equity. Deal, debt, equity, in that order. A lot of people think debt, like the money and the equity first. I need to go get the money first, and then I can go get a deal. No, 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 no. Doesn't mean you can't meet people who want to invest with you, but no one's going to commit to giving you money or investing alongside you if you don't have a good deal or something that makes financial sense. They want to see it, right? So a deal that makes sense, a pitch deck that explains the deal to them, shows them what their projected returns are going to be, and then a process, right, to execute. So a deal that makes sense, pitch deck, and a process. If you have those three things, raising money is actually not that hard. It's not that hard because there's a lot. Everybody wants to invest in real estate. You're here tonight because you invest in real estate and you want to. If you didn't want to do that, if you didn't want to figure it out, you wouldn't be here tonight. So everybody wants to invest in real estate. It's just, how do I make it happen when I'm capital constrained? Because most people are capital constrained. You're not alone. If you're watching this saying, yeah, it's all great, Justin, I don't have any money. Awesome. I didn't have any money either. In 2008, I was getting my ass handed to me in the financial crisis. But you know what? You know what I did have at that time? Knowledge, right? I was trained. I knew how to find deals. I could analyze them, put them together, I could manage them, I could close. I was extremely valuable because of the knowledge that I had. I could take that to somebody who had money, i.e. my partner now, come to the table, rock and roll. The company was formed. The Brennan Pulley Group was formed. And that's how we did it. But I didn't have any money, but I was resourceful. I figured it out. I knew my skill sets, and then I found the capital. Okay. And by doing that, now you have a great yin and yang. Great yin and yang. But equity comes from creative financing. It could be, seller financing. Creative financing comes by way of that. We teach that. It could be investors' money, OPM, other people's money, people you know, people you don't know, friends of friends of friends. Everybody knows somebody that has some money. Trust me. They just need a deal that makes sense, right? Pitch deck that describes it to them, and a process for them to execute on. Your money is involved in that, private lenders and partnerships. But those are the ways that this equity gets raised, okay? We went through that. Let's dive into it a little more deeply. So that way we can apply what I just showed you to an actual property. That's the one we were showing earlier, okay? This is that 8-unit deal. I'm going to break it down financially for you, show you where the money goes. I'm going to show you how it gets structured so you can actually see how this thing would get put together. Sound like a good idea? Yes, adding service charges and stuff, you can get extra money for an income too. I love that. Yes, absolutely. Okay. So let's take down this 8-unit deal, show you how it's going to break down. So I think they're asking $1,250,000, if I'm not mistaken, $1,250,000. Let's say flat line, we get it at $1,200,000. $1,200,000. We're going to have closing costs, maybe $100,000, maybe a little less than that, but let's say it's $100,000 for simple math. The property's brand new. Property's brand new. We don't need to do a lot to it, but we're going to add in $50,000 and just some capital renovation improvements that we may do or not do on the property. We want to add it in so it's there. So we're all in at $1,350,000. That's our total cost on the deal. Following me? Total cost. So now we're going to go out and we're going to get about $1 million loan, about a 75% loan to cost. 75% of that number gets me this loan. This loan is easier than getting a $200,000 house loan. Why? Remember, lenders give money to properties like this because they cash flow, and the property itself is doing the heavy lifting for you. You're not. They're not looking at you financially as much. They're looking at the property. Critically important. So getting this loan is easier than getting a $200,000 home loan sometimes. Okay? Financing's easier. Now you deal with the down payment. Okay, the down payment. How do we do it? This is where people get stuck. Well, I don't have $340,000, Justin. I understand you may not. Let me show you how it works. You, as the sponsor, the general partner coming in $4,000 in, 10%. 10% is your responsibility. This $306,000, remember, that can come in from OPM, other people's money. Could be creative financing through the seller. Could be private lenders, right? Could be all the above. all the above to raise this $306,000. You're out of pocket 34, but really, remember, you get paid beginning an acquisition fee, typically 2 to 3%. In this case, we'll make it 2%. That's 24 grand. That literally comes out at the close of escrow. It's like Peter to pay Paul. And people ask, where's that number at? It's in your closing cost number. It's already in the cost of the project. You're just pulling it out for putting the deal together. Very standard, very common. Okay. So ultimately, you're only out of pocket what? $10,000? And now you have control of about 30 to 40% of an 8-unit brand new construction project in Kentucky for $10,000 out of pocket. This money went in, that money came out, you're technically out of pocket 10 grand. Okay. So that's kind of from a high level how you're going to structure a deal like this. Now let me break it down a little further for you. I can blow this up for you. Here we go. So the property is going to have its own single asset entity, right? The property is going to be like 123 East Street LLC. Single asset entity owns the property. You, as the general partner, okay, are going to bring in 10% of the money. You're going to get 30% of the deal. For 10% of the money, I get 30% of the deal. Do that math for you. Over here, the limited partners are the investors or seller financing or creative financing or private lenders, all this other stuff, right? For them coming in, they're going to bring in 90% of the money. They're going to get 70% of the deal. They're also going to get an 8% preferred return on their money they're bringing in for being the main investor, okay? Here's the cool thing. As the general partner, not only do you get this, but that $34,000 that you brought into the deal, that $34,000 actually goes right alongside your other investors here. And you get all the benefits that they get over here, plus you get this over here. You get to call what's double dip. Double dip the deal. Very common, very standard. Okay? That's the great thing about it. And I'm going to quantify this for you in just a minute, but I want you to understand this concept. So that's how the deal is going to structure down. 30% over here, 70% over here. You're only bringing in 10% of the money and getting that percentage of the deal. It's awesome. I mean, the returns are stupid for you. Like they're stupid for how much money you're going to make over here being the general partner and putting it together. Okay. And then on the timeline, we talked about that a little earlier. Remember all these ways you get paid? Acquisition fees, asset management fees. You're going to get the cash flow, 30% of that, 30% of the profits and cash flow here, preferred returns, your percentage of this side over here, on and on and on. I don't want to dive into too much weeds today, but you get the concept. You get paid a lot in a lot of ways and a lot of different times throughout the ownership. Because throughout the entire, say, 5-year window, maybe it ends up being longer. Purchase price here, you're getting paid at the beginning. You're getting monthly, all this monthly cash flow. You're getting refinance money here, profits here. All this stuff's happening throughout the life of the project and the property. You're getting paid multiple ways, multiple times throughout the life cycle of that property. That's the beauty of it. So real quick, closing properties. I'm just going to breeze through this real quick because I wanted to focus on finding, analyzing, raising money. Those are the first 3 in the 5-pillar method that we showed at the beginning. Remember that? This part right here. So we've gone through this. We've gone through that. We've gone through that. Okay, now we're here at the closing side. So things to focus on when you're closing deals. Property inspections, legal, the finance, the renovations. We literally hold your people's hands when they come into the community. We hold your hand through this process because it's a lot. And you don't want to make any money mistakes here. So you need, a lot of Q&A back and forth as you go through this process of closing on your first, second, third, whatever deals. The hand-holding is critical to make sure you don't make any dumb mistakes at this part of the table. And then managing the deals, right? Do you self-manage them or do you get a hire property manager and then become an asset manager managing the managers? Managing the managers. So I'm going to break down a deal real quick. This is literally a case study deal. Property we bought. And I want to show you for $18,000 out of pocket, I controlled a 31-unit deal for $18,000 out of pocket. Okay, here we go. So we bought the thing for $1,525,000. We renoed it for $400,000. Closing costs, total all in $2.15 million. We got 40% of this deal. 60% went to the investors. We went out and we got a loan for $1.5 million, about 70%. About 70%. Equity was about $650,000, give or take. We brought in 10%. That's our responsibility, is 10%. We brought that in right here, $64,000. $90,000 was brought in from other investors. We had about 7 investors in this deal. But remember, now I get the fun part. I get an acquisition fee. Okay, $64,000 goes in, $45,000 comes out. I'm out of pocket about $18,000. And I have control of a 31-unit deal. I'll keep going. So let's quantify this for a minute. What do I get? We bought the property here. After the renovations, we had it reevaluated at $3.6 million. So we did a 100% cash out refinance. We pulled out all of our money that we initially put in the deal, plus money on top of that. Best part about it, it was tax-free money. Because when you do a refinance like that, it's tax-free. FYI. Why? IRS loves you. They love creators. Remember, they give those people all the tax benefits because they're growing and moving a lot of money. Same thing happened there. We get asset management fees of 1%. I got 40% of the profits in the cash flow. So I'm over here doing $2,000 a month for 5 years. That's $120,000. Then net profits from selling the deal about $470,000. So making over $590,000, because this doesn't even include the tax benefits and everything on side of that. $590,000 on $18,000. So 32x on my money. I mean, think about that. The returns are stupid for you when you're putting these things together and running them. Stupid for you. But that's a literal case study example. Remember in the beginning, I was telling you in 2008, I was getting my ass handed to me. I didn't have any money. When you come into this thing, there's one of two things you're bringing. You're either bringing the money, right, the real capital, or you're bringing the sweat, meaning brain cells. I don't even know if this looks like brain. So sweat equity, right? Knowledge. Knowledge is very powerful. If you don't have a lot of capital, but you can have all the knowledge, right? Remember, your income is equal to the problems that you solve. So if you're very knowledgeable in something and you can go find deals, you can analyze them, you can put them together, you can help control and close, you can manage and blah, 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 blah. You can run the gauntlet. You are extremely valuable. You solve big problems for somebody that has money and wants to invest in real estate. They just need a trusted partner to do it with. You're very valuable to them. So real money or sweat money, it's one of the two. So I ask you, with people in here, is it more capital money that concerns you? Or is it, hey, I just need to be educated. I need the knowledge, the hand-holding, community mentorship stuff that's going to help me kind of take it from where I'm at, which is kind of, I know I want to do it, to let's go. Like I'm ready. I want to make it happen. I'm tired of the crap I'm in now, right? You all said it at the beginning, like you're tired of certain situations. You want to grow and you want to do all these things. Well, here's the chance. Like, do you really, or do you kind of? So, because everything you want in life that you've heard this a million times is outside of your comfort zone. I say the only thing keeping you from where you're at and where you want to go in life is 7 inches. And then people are like, what's the 7 inches, Justin? I say it's the 7 inches between your ears, right? The scary stories that we tell ourselves between our heads, you're probably doing it right now, right? Limiting belief systems. Oh, I don't have the money. I don't have this. I can't do that. I'm not as smart as this. I'm not so. You're doing it right in your brain right now. You're doing it. Because it's totally natural. We all do it. But you have to avoid that because community is everything. That's how you grow. It's collaboration and community. It's everything. So Barbara, we don't have a done for you model. There are those out there, but you might as well just be a passive investor if you're going to do that. We have really, you can invest along like us. If you just want to invest in our company, we can certainly, take a look at that and just be a passive investor. But we really provide a community for done with you, like literally holding your hand and doing it with you model, right? Much different. So yeah, there are done for you models. It's just totally, it's totally different. It's totally different. So totally different. But that's how it works. Yeah, you want to either done with you or done for you in terms of those models. Okay. And it's just a matter of what you're really looking to accomplish. But we do really the done with you model. It's really the done with you model. So yeah, sweat equity model. That's right. That's right. So I'm glad that everybody kind of is conceptually understands like the sweat, the community, how it all works. So it sounds like people have interest in kind of learning about community, mentorships, all that stuff, which I love. And for those folks that are interested in it, I'll get into that right now, okay, and just breeze through it. So what is even inside the community? If people have interest, you want to come into it, certainly can. You get lifetime access, and that's to the community, to the tools, the systems, the operations, every single thing, lifetime to it, okay? You get live weekly coaching with me. You don't get some random hired coaches and random stuff. You get a success coach assigned to you, and then I'm doing the live mentorship coaching every single week, okay? You come into the community, so you're part of it. And now you're community, you're doing partnerships, opportunities, all that collaboration happens inside of there. The partner, the finance, Q&A, questions, all of that has to happen because that's how people feel connected, really, is inside a community and doing things together. You do get a success coach assigned to you as well inside the community. We have a litany list of, you won't have to create anything. We have literally gone out inside of the back end and put everything in there that you'll ever need to go buy an apartment building. Because what I didn't want people to do is come into a community and have to kind of create all this stuff on their own. You're busy. You have a job or career already. You're trying to get into at least your first deal, if not a bunch more based on everybody's wants and needs. The last thing you need to be doing is doing all this kind of grunt administrative stuff and not focusing on finding, analyzing, putting deals together, making things happen. That's where I want your energy. With the limited time you have, 4 to 6 hours a week, literally 4 to 6 hours a week. That's how I got started. Do your 9 to 5, do your career, come home, your bird dog and stuff a little bit at night, few hours a week, putting it together until you get to a point where you're making enough money with it that you can kind of make a decision whether or not you stay with your current situation or you stay with it. Completely up to you. But now you have power, right? Now you have leverage because now you're moving into the financial freedom category. That's what you want. But all the resources and tools are in the back end. We assist you finding the deals, analyzing the deals. Like people submit their deals in the back end of our system. We help you review your numbers before you're making offers. Because we, especially in the beginning, when you're learning how to do this, you want to know that your numbers look good. You're making good decisions. If you have a lot of Q&A, we want those answered for you. It's intimate. We want access and intimacy and hand-holding. That's like big three in the system, okay? Funding the deals through the financing. We talked about that. Closing them and then managing. Because those are really your 5 pillars that we talked about at the beginning that we put together, okay? That we put together. So all this is part of the community. So then people ask, well, what does it cost, Justin? What does it cost? I try and lay it out pretty simple, okay? So normally it's $8,800. Normally. But here's my undeniable offer to you tonight, right? Irresistible offer to you tonight. For people that are on the webinar, we're going to cut this out and we're going to take $1,000 off, okay? But bear with me, we're going to add some value into it. So $7,800. Keep in mind, it gets you everything we talked about. Lifetime into it, mentorship, coaching, everything, okay? So $7,800. Then on top of that, what I'm going to throw in is actually some one-on-one with me, right? We can start with a 30-minute one-on-one to really dive into where you're at, where you want to go, how do we look at your current situation, and how do we begin to move the needle for you, all right? And for everybody that does this in the next 72 hours, I'll throw that in. God, it was an added bonus, me in a one-on-one scenario for at least 30 minutes going through this for you. So I kind of be very transparent with folks about it. So if this is of interest to you, set aside the money for a minute, okay? Screw the money for a second. If you believe that this could be of interest to you and you'd like to learn more, put your name and your email in the chat privately. You don't have to send it out to everybody. Do the host and stuff. Put it into the host and the panelists inside there, and we can reach out to you. Additionally, I'll put in a link in here for you. You can book an informational call direct, okay? I'll put this link in there, and then Kevin and Shai, you can kind of help out with that as well. But that is a link. If you just want more information, want to learn about this in detail, you can do that. And this link right here shows you everything I just talked about, but a nice little page for you about the mentorship and the community and everything that's included in, okay? But set the money aside for a minute, because the money's irrelevant if you don't believe it's going to help you move the needle. It's irrelevant. I need you to believe, hey, okay, I can make this happen. We're going to make this happen, because that's irrelevant if it makes you a millionaire, right? The key is your belief system, and then us helping you get you to where you want to go. That's what it's all about. And if you believe that can happen, then go in there, set up an informational call. Let's make it happen. So phone number and email in there privately to us. We can reach out to you, number one. Go ahead and you can book an informational call on that link as well. That link I just sent in there. And that way you can set it up. So that way in the next 72 hours, you can make a decision if it's a good fit for you or not. And if it is, like I said, I'm going to throw on me a little one-on-one time. We're going to cut out $1,000 for everybody that's on here tonight. That's why if you put in your emails and stuff in there, we can track it. And we'll give you the discount for coming in and doing it. Okay? And that way you're getting a great deal, great opportunity, because most of the time it's that. And to be quite honestly, and I mean this wholeheartedly, this is not a BS statement. There's probably close to $70,000 in value in the program. 25,000 of it's probably just in the resources and tools that you get between the pitch decks, the deal analyzers, letters of intent, legal documents. I mean, due diligence checklists, how you find markets, how you find the brokers. I mean, just keeps going. I mean, on and on and on. Data and websites, all access to all of our vendors and systems. You get access to all of our vendors and systems, attorneys, accountants, bookkeepers, you name it, construction guys, everybody that we have around the country. We have it in a nice little system inside the back end. You get access to the vendors and systems. We're trying to alleviate the bottlenecks. You're going to be able to come in. You can submit your deals to the lenders in the back end. Submit the deals for us to help you review them and hold your hand through analyzing the deals. All of it. It's an intimate hand-holding experience. That's why you're doing it. You're not doing it just to take courses and lessons. Anybody can do that for you. You're coming in to get handheld, mentored in a community of like-minded individuals who are doing things big. Okay, that's why you're doing it. I agree. I mean, you got, let's call it 3 months left in this year. And I will end with this. Every year, at the end of the year, last week of the year, I write myself a vision letter. Has anybody ever done this? A vision letter. It's a 3-paragraph letter that you write to yourself about personal, professional, health, and spirituality. And you write it in the future tense. In the future tense, literally. I wrote it for this year. And you know what's crazy? The stuff I wrote in there in December of last year of 2023, as you kind of read it, and I literally read it every day. You read it every freaking day. I'm checking off all these things in that letter. And it's the most mind-blowing thing you ever see in your life. You're like, man, I never thought that would happen. I never thought we could do that. I never thought I'd accomplish that. You got to write it down. You got to read it. And you have to send the frequencies to the universe and allow the how to show up. So do that. So you're talking about great for the end of the year. Yeah. Put this in there and let's go. Let's make it happen. Nothing's coming to save you. If you want to do this for yourself, it's time to go. It's time to go. I keep telling myself the last thing, one of my greatest fears, honest to goodness, is sitting on my deathbed at 80 years of age, having to talk to my 40-year-old self and tell my 40-year-old self, look, man, I'm sorry. Right? I'm sorry. I didn't go for it. I had the chance. I had the opportunity. I'm gifted. I have everything I need. And I just didn't do it. What's the worst thing that happens? You fail? Okay. Get up and do it again. The worst thing is you have to be on your 80th deathbed talking to your 40-year-old self, and then more importantly, look at your children's faces when they know you can go for it and you choose not to. They're looking up. They're looking up. And that scares the crap out of me. Literally every day scares the crap out of me. So, perfect. So yes, I think DSCR loans would be best if you're investing alone. They're all DSCR loans, by the way. Satish, it's all DSCR loans. because that's how the bank evaluates commercial property, which is multifamily. They use DSCR loans. Yeah, they're not evaluating you as much. That's why it's easier to get the financing. You're dead on with that. You're dead on with that. Yeah, people in your community will only invest when I have gotten the first one. I disagree with you. I'm going to disagree. I totally get where you're coming from. A lot of people have that limiting belief system. Not the case. You're literally telling yourself that, and you haven't even attempted it. And you know why? Because you don't have a deal that makes financial sense. You don't have a pitch deck that explains it correctly to them and shows them their returns, and you don't have a process to put it in place. That's why people won't invest with you until you have your first deal. You're creating that. I guarantee it. Okay. If I would have told myself that on our first deal, that was 27 units and I had to raise 900 grand. If I would have told myself that, we would have never gone anywhere. So trust me, you're completely limiting your belief system with that statement. Guaranteed. People will invest with you. If you have a deal that makes financial sense, a pitch deck that'll walk them through the offering, right? What they get, and then a process for it to happen. Jay, great question. Does the bank require recourse on the loans? Depends. Depends on the type of loan you get. In most of them, no. They are non-recourse loans. Some of them, yes. If you're doing construction style loans, they may have some recourse on there, but not full recourse. So it depends on the deal and the loan structure and stuff. But most of the times it's non-recourse debt, even on the smaller deals. If you're doing a call it agency type debt, Fannie Mae, Freddie Mac, that type of stuff, they may ask for partial recourse, some recourse, no recourse. It depends. Yeah. Davey, I appreciate that. Thank you very much. Yeah, I mean, you have to have a real, don't ever give up. Don't ever give up. You only lose if you don't give up. So I should say, you only lose if you give up. Now, I'm not saying be delusional, right? I mean, if you're 5'4", trying to go play basketball, not likely, okay? But I am saying that, look, if it comes down to sticking in there long enough, learning and making things happen and never giving up, don't ever give up. If you don't give up, you can't really lose. It will eventually show up for you. I guarantee it. I mean, there's been many times where I wanted to give up, many times. But you fight through that belief system. You have to, because no one's coming to save you. What do you want? At the beginning of this, everybody said, I want this, 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 and then this. Great. How bad do you want it? You kind of want it? Or do you really want it? Because if you really want it, you can have it. You just got to go. You're at the edge of the cliff. You got to go and allow the how to show up. Okay? Allow the how to show up. You have a friend who is a broker. Is there anything that I can ask her for starters? What kind of broker? Commercial broker or residential broker? Big difference. Interest rates matter. Yes. Yeah, the interest rates do matter. That's why we've had such a troubling time the last 24 months. Now the Fed's starting to bring those down as we see, but that's, it's a starting process. It needs to happen. It's been a rough 24 months. Both. Okay. Yeah, you can actually ask them if they're, depending on what types of properties they, list. If they're doing multifamily, you can absolutely get in there and say, hey, do you have access to these types of things? I'd like to start investing in them and putting them together. That's going to be your first entry in for that. Yeah. But listen, you got to know what you're doing. You can't just go talking around. You have to get in and learn so you can actually have success, right? And move that needle, right? Like I said, taking money aside for a minute, right? Because what we do, just FYI, and we do it for the people on the webinar, this can get broken down, guys. This doesn't have to, ideally people do pay up front, but we need to make sure you have some capital for deals. So we don't want to strip that away from you to go all in on this and then not have the ability to go get deals. Like you need 15 to 30,000 in cash to go start. There has to be some capital in the deals, as we've shown you. Okay, so you need some capital to start. But if this needs to get broken down a little bit, don't let it hold you up. Do not allow money to stop you, guys. I need you to be more resourceful and think, not can I afford it, but how can I afford it? How can I make it happen? Right? Think of the end goal and okay, we can figure out the money side. We can figure out the money side. Don't worry about that. The question is, are you interested? If the answer is yes, then put your name and your email and everything in the system. we can reach out to you or book directly from that link. Okay. And you can go right in there and set up a informational call and we will speak with you. And then if you're coming into it, I'll give you some one-on-one time with me and we'll break down your current situation, where you're at and where you want to go. Jay, is San Diego a dreamer's market for 10 to 20 unit deals? Yes and no. It's a tight market, but there actually are a lot of mom and pop deals in San Diego that you would probably want to flip. I don't think you'd want to renovate and hold on to them too long, because you could actually renovate them and make big pops on them by selling them to high net worth individuals that just want to park money and preserve wealth in San Diego. As you know, very expensive market, but there's a lot of wealthy individuals who will go buy a 10 unit, right? And hold on to it and just stick a bunch of capital in it to avoid taxes, preserve wealth. So if you can find a rundown little 8-10 unit, renovate it, sell it, make $300,000-$500,000 or more on that flip, yes, there's a market for that in San Diego. Do you get deals from private non-listed networks? Yeah, I do now because I built those. But in the beginning, if you don't have a big network, then you can leverage the brokers who have the listings, right? They're saying, hey, look at our listings. You get access, you build a little rapport. And through that rapport, you get access to the pre-market deals. Right? It's a process to go through, but we teach that. We hold people's hand through it, what to say, how to say it, all that stuff. And listen, we're here for everybody. Whether the community's right for you or not, doesn't really matter. We're here for you. We'll keep doing these live Tuesdays as best we can and trying to inspire, help, and get as many people that are, ready to go, highly educated, doing deals, making it happen, bring them into the community, and let's go do some deals together, okay? Let's go do some deals. Because we love, that's how you grow, is the partnerships. All about the partnerships. It is truly, because people ask, why are you doing it? I said, it's because of this, right? Think about it. It's mutually beneficial because I'm out there buying apartments, but the way we scale to 10,000 units, what if I can create a community of well-trained investors around the country who we're helping get into deals and be successful and become millionaires? And by way of law of reciprocity, now we have opportunities because you're going to be able to find deals that are probably larger down the road that now we can partner on. Now you get into a bigger deal where otherwise you couldn't. Now we partner and co-GP a deal and we get into 100 unit, 50 unit, 80 unit. That's what this is about. Everybody wins. Everybody grows. Everybody gets rich. That's why we're doing it. Okay? That's why we're doing it.